Hey everyone, welcome to today's show. On the final bar, we're going to have a guest, Ari Wald from Oppenheimer, sharing his take on what's going on right now. We've got this bullish move within a bearish phase, and today leans more back to the downside. The market down over 4.5% in terms of the S&P. We're going to look at some of the sector themes, some of the pieces that make that up. Also, we're going to do a mystery chart with a stock idea that you're probably going to want to be familiar with. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's show. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining me every weekday after the close to look at the charts together, try to connect the short-term movements of the day with the long-term trends, make sure we're on the right side of things. Today, we sort of go back to market negativity. We sort of had the quarter end yesterday, and there's speculation that there are a lot of, sort of quarter end window dressing types of moves, rebalancing and such. And all of a sudden we're back to reality, the first of the new quarter, and the market showing us what I feel is sort of the primary direction here. It's been, I think, the weight of the evidence remains negative from a technical perspective, and we're going to try to break down some of those themes. It's interesting that as we think about sector rotation, I think the sectors are really interesting to look at right now, and one of the charts we'll look at in a little later is looking within consumer, looking at offense versus defense and what it might be illustrating about the overall environment. Got a lot of guests to help us along the way. I mentioned Ari Wald today, who's a fantastic analyst, to give us his quick take on what's happening. Tomorrow we have JC O'Hara. Next week we have Harry Boxer, Jesse Felder. And we just added for April 9th, John Kosar from Asbury Research in Chicago. So some fantastic guests. And again, can't say enough, we've been able to bring on some really solid analysts, strategists to help us break down things. Two other quick things. This weekend, starting I think Thursday and Friday, there's an event called Tech Wizards 2020 that I'll be speaking at along with some other fantastic speakers. I'm going to be talking about relative strength and how it fits into the trading toolkit and where how you should incorporate it in your process. So on the screen, you'll see some information. Check out that event if you can. Hope you can join us for that virtual event to learn from myself and others. And then earlier today, we actually showed our latest special, which was called The Pitch, and had some really good stock picking ideas and people breaking down their approach. So you're going to want to see that on our YouTube channel as well. Let's get into our market recap. So as I mentioned in the introduction, certainly sellers outweighing buyers, or an exhaustion of buyers, or more desperation than euphoria, however you'd want to describe it. The market went lower. And the S&P down over 4%, finishing around 2470. Mid caps and small caps down even more. So mid caps down almost 6%, small caps down over 7%. So this is really sort of the riskiest, most risk-on part of the market, leading the way lower by that measure. Looking at the cap tiers, today's sell-off has pushed the VIX back up to 56 to 57. In terms of other markets, we also have bonds. Yesterday we had this situation where it felt like there was this divergence between stocks and bonds, but then they both sort of turned over and sold off into the close. Today we actually get a little more of a differentiation, with the TLT up 1.4% with stocks down. The US dollar actually up as well, with the UUP now hitting $27. Commodities continued their stretch of weakness. We talked about commodities in a bit of detail yesterday with the DBC, a broad commodity measure, whatever measure you look at, down another couple percent today. Gold is a notable outlier, though, after a rough day yesterday, actually rebounding a little bit more to the upside. So today felt a little more like a traditional risk-off sort of day in terms of asset allocation. And when you look at the sectors, I think that sort of plays out in a little bit as well, but not completely. So you had consumer staples, the number one sector. And again, everything was down, but it was down the least, followed by healthcare and then comm services. At the bottom of the list, you had financials, and we looked at that ratio yesterday, the day before, I forget, about tech versus financials, and just the underperformance of financials has been not an acute issue recently. This is more of a chronic issue, going back many, many years with its underperformance, and certainly leading the way lower today, but also followed by some of the other defensive parts of the market, so real estate and utilities. So at a time when yields are at all-time lows, and you might expect that people would be flocking to high dividend payers, that is not a broad spectrum move over to high dividend payers, at least today. Well, you had some of these, high dividend paying, relatively conservative, sort of low beta names actually leading the way lower. Now with real estate, that's not 100% fair, because you have a lot of exposure there to, malls and office space and other areas that are certainly potentially going to struggle here. But I thought interesting to note. I think a lot of times we get into trouble thinking the market's doing one thing. What sectors, what groups should I be in? And it's just a great reminder that it's not always a one-to-one relationship. In terms of ETFs and markets that were up and down, I think it's worth noting that there were some. Everything was sort of down, but others down a lot less than some of the ETFs. At the upper end of my list of equity ETFs, I think it's worth noting you've got a lot of China-oriented ETFs here. Again, all down, but down a lot less than others. Frontier markets actually the best of the bunch, followed by Russia. But if you look at what was down the most, and again, we've just got some differentiation between the ETFs up and down the most. You have India, South Korea down 7.5% at a clip, followed by a lot of developed Europe there at the top of the list there. When we're looking at industry groups, not many up. Only 4 out of the 100 plus Dow industry groups that we follow were positive. Coal is sort of a rounding error within energy, so I usually skip that one, but it was interesting to see mining and gold mining groups up the most. These have consistently been at the upper end. If you look at the price chart, it's not bad when you consider the average price chart is close to breaking down or nearing new lows or just bouncing off those lows. These are groups that have actually recovered a little more than that. So they're both up almost 3% today, followed by aluminum, also in that same sector, and materials. That's how that's one of the top sectors today. Then we see food retailers and wholesalers, non-durable household products. So again, some of the other consumer staples groups up or down the least today. On the downside, we have airlines down another 13% today, recreation services down 18%. So again, even though the market was down and struggled, some groups really leading the way lower. And you'll notice here things like mortgage REITs and retail REITs, which really have sort of driven things down significantly. I want to look just very quickly at at a breadth measure or two, just to sort of update on where we're at there. I think, in terms of interesting charts, this is one that I think is a really important one. This is looking at the cumulative advanced decline lines for the different cap tiers. We've looked at this often together. And again, for me to get more positive, more optimistic about the short-term direction of the market, you'd want to see this sort of thing put in a higher low. And this is the advanced decline line on the S&P. At this point, you're seeing a bounce up, but then it certainly feels like we're just putting in a lower high until we establish a higher low, until we establish some sort of stability there. I don't think it's that exciting. I think that's sort of struggling a little bit in terms of the breadth picture. A second thing I wanted to look at was this one. Where are we at? Nope, not quite. Sorry, I'm on the wrong page. I'm going to look at the breadth readings because I want to look at the advanced decliners. This is the chart we were looking for. So this one is actually looking at the percent of stocks that are up or down each day. So it's just looking at the advancers decliner. Sorry, I'm whipping all around the StockCharts platform. Here we go. So here at the bottom, we have the NYSE advancers relative to the total number. At the bottom, we have the NYSE decliners relative to everything else. So again, this is saying 91% of listings on the NYSE up today, down today relative to yesterday's close, only 8% higher than it was yesterday. So clearly a day of distribution. I think if you want to get a sense of how this market has evolved in the last month or so, look at early to mid-March, where you had this grouping of days of over 90% down days. Then about a week ago, you had this cluster of days around 80 to 90% positive. So coming out of the lows, you had a lot of stocks, especially on that first day up. All of a sudden, you had over 90% of stocks going higher, and that was sort of the trend. But now look at how that trend has reversed, and you've seen a steady decline in advancers and a steady increase in decliners. And now once again, we have a 90% down day, showing that most stocks, if not almost all of them, closing down today. So again, those tend to be characteristics of a bearish phase, or you've got more decliners than advancers, and that extreme movement sort of shows you the negativity that we're seeing in the market. The one last thing I wanted to show was looking at the Zweig breadth thrust. This is something we talked about. And if you're not familiar with this one, look at our YouTube channel for our shows last week. And we talked about this on Thursday or Friday, I want to say. And it basically is a measure of breadth, a measure of extreme breadth. Basically, we have a weakening breadth picture, and then you go higher, and within 2 weeks, you eclipse sort of this upper bound. And this is based on the work of Marty Zweig. It's based on advancers and decliners, and it's using exponential moving averages of that to show those extremes. And just to confirm, we did not get that Zweig breadth thrust. In 10 trading days, we didn't eclipse the upper end, 0.61 or 0.615, my friend Tom McClellan reminded me of. So we did not get that. So, that would have been an indication of a nice bottoming pattern. That would have been a really good bullish guidepost. And unfortunately, we didn't get it this time, folks. This is sort of illustrating, further potential weakness there. And again, today feels like an initial move, sort of confirming that downside. That's our market recap for today. Again, we didn't get to some of the equity-specific ideas, but again, a lot of movements around there. As always, I'd encourage you to spend some time with our scooter rankings. Those are the ways you can, sort of identify what's moving and what's where on a relative basis relative to one another. Our next segment is called the mystery chart. This is something we haven't done as often recently, but it's one of my favorite segments. And what we do is show you the chart now. I'll explain what it is. Love for you to think about, jot down an idea of what you think it might be. And then later in the show, before the end, we'll unveil what that mystery chart is, why it's an important thing. I sort of let the cat out of the bag a little bit in the introduction. It is an equity listed in the US, but that's all I'm going to tell you. And we're looking at the last 2 years. My question is, what stock is this? And I'll tell you why. It's a really important stock at a really important juncture. So my question is, what is this chart? Our next segment is a level up. And what we love to do in the level up segment is actually use the StockCharts platform, try to upgrade our use of what we're doing. And then again, I found with many platforms I've used over the years, you tend to use a small percentage of the capabilities. And I think it can be really helpful to see how others are using a platform like StockCharts in an advanced way and help you understand why it can be of help. So I wanted to show you this. This is basically the CandleGlance functionality, and you've probably seen it if you've watched the show for any amount of time. Our founder, Chip Anderson, really does not like how many charts that I open when I log in the morning because it taxes our servers just a touch. But I have found that looking at these CandleGlance pages is just a great way to get an overview of everything that's happening in the markets. And so that's where I tend to look at pretty much everything. I'm showing you the list of the 30 Dow stocks, and I have them organized in a CandleGlance just alphabetically based on their tickers. This is something I've looked at for a long time as a way to just visually identify what's working, what isn't. So the value of this is, I'll tell you what it is and why it's important, then I'll show you how you can set it up and a couple tips on how to use it really effectively. For me, it's a way to just sort of get the 30,000 foot view. Take a group of sectors, a group of ETFs, your personal portfolio, your PA, your client holdings, whatever it is, and just look at how they're moving relative to one another. I got this idea from the Fidelity chart room. So my previous life, running the chart room was this huge physical room dedicated to technical analysis and market history. What we did was we had a bunch of individual paper stock charts put on the wall. And you learned a lot just from looking at the individual charts and thinking about Pepsi or Merck or JP Morgan or whatever you're looking at. But then if you took a step back, a couple steps away from this big wall, you'd be able to draw other conclusions because you could see how the banks looked relative to the airlines, relative to big pharma stocks, relative to energy names. And it allowed you to really compare them on an apples to apples basis. That's where I think the CandleGlance kind of does. It's like having your own mini chart room within the StockCharts site. So you can have a bunch of things on here, and what you do is you can then visually compare them. So I can see which stocks, in this case, I'm just looking at the price and the 50 and 200-day moving averages. I'll note something like Intel is actually testing its 200-day moving average from below, very similar to Johnson & Johnson, which just tested it and arguably failed it, coming back down. I'll compare that to something like Microsoft, which is actually broken significantly back above its 200-day moving average and compare all of those to something like UTX, United Technologies, which is nowhere near and is below two downward sloping moving averages. So in a list of names, it's kind of like throwing the charts down on a table, looking around and seeing what's what. Now, this chart in particular with the price and the 50 and the 200-day, that is actually customizable. So that actually comes from the chart style system. And here's my tip for you to wind this down. If you go to one of your charts and at the bottom you have this ability to set your chart styles, you may have one called CandleGlance. And if not, just create a new chart style with this exact name, CandleGlance. And what it'll do is it'll show you this chart. You can customize this however you want. So I just have a price going back for the last year, the 50 and 200-day moving averages. And then when I bring up my CandleGlance page, it's all using that chart. So if you're focused more on relative strength, you can set that up. If you want to look at RSI or a shorter term time frame or whatever you want, just set up that chart style. That's what's going to be reflected on any of your CandleGlance pages. And finally, to get to it, all you need to do is set up a chart list. And when you bring up your chart list, you have the drop down of the ways you can view it and just select CandleGlance from the list and you're done. So that is a level up segment, just trying to upgrade your use of the StockCharts platform. I found the CandleGlance pages to be a really helpful way. It's kind of a chart room within the StockCharts platform. Great way to compare names across or ETFs across different charts, different patterns. We're going to take a quick commercial break. Back with my guest, Ari Wald from Oppenheimer. We'll see you in a minute. Hello, everyone. Welcome back to today's show. I'm Dave Keller here at StockCharts. I want to thank you for joining us on the final bar. Please keep your questions and your feedback coming to us. The final bar at StockCharts.com is the best way to get a hold of us. We'll do another mailbag segment later this week. We'd love to answer your questions about the markets, about technical analysis, about charts, whatever. Nothing is out of bounds, and love to help you navigate this market. We can use all the help we can at times. And to help us today, I'd like to bring on our next guest, which is Ari Wald. Ari is the technical analyst at Oppenheimer. There are certain people I do not miss from my Fidelity days, Ari, but I definitely miss having you come around and picking your brain on the markets. How are you?
Hanging in there, Dave. Thank you. Thank you for having me back on the show. And what a time to be on. I mean, the importance of historical perspective can't be overstated in times like these. And what a better way to do that within a chart. I'm sure you'd agree.
It's absolutely right. Now, you set two charts ahead of time, which I really appreciate. The first was looking at new highs, new lows. What is this telling you about the environment right here?
That's right. Well, the key takeaway coming from our work is that March's collapse marks opportunity for long-term investors, but the likely need to base over the coming weeks means expectations for traders still need to be managed. And this puts our focus on the selection process. So let's start big picture. And with a chart going back to the 1940s, it shows the S&P 500 overlaid with the number of new 52-week lows on the New York Stock Exchange. So we're flagging that the recent reading of over 1,300 new lows is on par with one of the largest capitulation days in market history. So historically, this marks the start of a basing process, but from all the annotated years that I'm showing in the chart, which were all readings of at least 1,000 new lows, I can't show you one example of a V reversal. If you were to go back and look at each initial high intensity low, it sets the stage for long-term recovery, but it's also common to see a test of that low about 6 to 8 weeks later. So this is the roadmap we're following. We think March was the bang, and now we're looking for the whimper.
It's such a great chart. So two things that come to mind looking at the chart. Number one, you've made it clear that all bear markets in history have so far been followed by a bull market. So that's encouraging. But it also, I mean, it's a great illustration with the time frame. Just, I feel like if your runway's long enough and you think of this as a process, this is a process with which we get to new highs at some point. And if you're a long-term enough investor, that's sort of how I would interpret that. Is that fair?
I like how you phrase that. Every bear is followed by a bull. And I think equally important in what we're trying to stress is that as much as we just hit that market high just a month ago, we saw extreme readings in that March drawdown. If that wasn't capitulation, I don't know what was. What is?
So chart number two, I think the question obviously is, how do we get there? So here you're looking at momentum and high versus low momentum. What is this showing about the characteristics of equities at this point?
Yeah, this is kind of shifting gears a little bit and discussing how we're advising our clients to be positioned kind of through this bottoming process. Now, we're advocates for the momentum factor for the long run. It's based on research that shows stocks that have outperformed over the prior 12 months are stocks that usually continue to outperform. So as momentum investors, this means we're inherently long the black line, which is the Dow Jones High Momentum Index, and we're essentially short the red line, which is the low momentum series. So the silver lining to the broad-based selling that's been suffered, it's been across the board, is that from a market neutral viewpoint, at least stocks that were showing relative strength into the very peak have outperformed the relatively weaker stocks. So this has at least kept you out of the stuff that's been exceptionally whacked. And we expect this to continue. If you were to look back at the 22 major market lows since 1932, you have to get the market call right to buy the real beaten up toxic stuff, which right now is energy and airlines and retail. And this means we'd rather be wait for the market to fill out its space and be a little bit be late with these areas. Instead, we want to stick with our discipline, and we recommend buying leadership, and specifically buying leadership in technology, because tech has outperformed more than any other sector 6 months after those same 22 market bottoms. So it's pretty much a hedge for us. We think the high momentum of software should outperform through the base building, and the cyclicality of semiconductors should pull up the slack if the recovery comes sooner than later.
It's so interesting. You mentioned, obviously, technology has been a great story. I mean, it's outperformed consistently, and it's outperformed in the up phases and also in the down phases. So it's a great call to be thinking of that as a place to be. I'd love to just finish up with a quick question. Let's say I think people are afraid of a V bottom, and again, today may have sealed the idea that that's not going to happen, but it's just one day. If we do get a more of a V bottom, if we start to accelerate, at what point would you have to admit, okay, this is not a bottoming process, the bottom is in place, we need to be more aggressive? Is there a certain S&P level that would be broken, or is it more about leadership in stocks or sectors that would be outperforming that would tell you? What would tell you that the recovery is happening quicker than you might expect?
Well, I'll go off of actually some of your comments. I think you hit it on the head in one of your earlier segments. You're looking for the Marty Zweig breadth thrust. I'd be looking for a big explosion in participation where, one indicator we look at, stocks above their 200-day average. If that indicator was to really start to explode higher, so I guess in terms of levels, not only the S&P getting above its 200-day, but if you saw a real expansion in stocks getting above their 200-day, we found readings, if you start spiking to 60, 70%, that's usually the start of a new bull advance. Those numbers continue. You get very high returns when that's the case. And I even expect some of this ratio to actually reverse a little bit. If we start to see these low, the real beaten up stuff start to rally in my face and outperform and turn into leadership, you could see that big collapse in the line in 2009. That too would signal that the market's embracing the real beaten up toxic stocks, and that historically has been a bullish omen for the market too.
This is a great take, Ari. Thank you so much for sharing your perspective with us. Stay safe, best to you, your family, and we'll talk to you again soon, okay? You as well, Dave. Take care. That was Ari Wald from Oppenheimer joining us from outside the New York area. Such a pleasure. And again, I've had the pleasure of getting to know a lot of technical analysts over the years, and I will tell you, Ari is definitely one of the good guys. Always a pleasure to get his take on things. We need to move on to our next segment, and that is back to the mystery chart. My question to you: did you guess what it was? So I did give you the hint that it is an equity, and sort of got the sense it is listed in the United States. We're looking at the last 2 years daily price data. This is a stock that we obviously, hopefully, are very familiar with, Netflix. I will tell you from personal experience, my family has been Netflixing more than ever, among with other streaming services. But, we had yesterday our special program, The Pitch, 15 stock ideas for this sort of uncertain time. We had Tom Bowley, Grayson Rose, Mary Ellen McGonigal, sharing some different stock picks. None of them picked Netflix, and we were talking afterwards, and they all sort of said it seems so obvious. We were looking for some other ideas out there, and I think that when I'm looking at a chart as with if I had to follow one chart just to get a sense of where things were at and whether something was playing out broad market wise, I think Netflix isn't bad, and here's the reason. If you look, this is the last 2 years. You see this huge basing pattern. It's essentially been range bound between 230 to 250 up to the peak around 390, 400. And if you look, there's been this consistent resistance level. After selling off summer of 2018, it hit a peak around 390, 385 here late 2018, rallied right back up to that same level here in May, and then again in July of last year, and then once again came back up, and this is where it's failed a number of times. So here in the last year, we have sort of this cup and handle pattern, this big rounding bottom, and then the shorter term pullback. And I think a confirmed close above 390 would really sort of confirm that. And it measures way higher, measures to 500 plus if you take the height of that pattern and project it from above. But we have to break above that, the neckline, above the rim of the cup, if you will, to confirm that, and we haven't. So this is a chart. If I want to look at a chart other than the S&P just to get a read on what's happening, I think Netflix is a really good one to look at. Now the question is it a great idea? And I think overall there's been great relative performance here. I don't see that changing. I see it, it's continued to look very, very good relative to other stocks. So I think it's decent as an equity bet, but I'm also using it as more of a broad market measure. Can a stock like this break to new highs in a meaningful way? And I think that would, for me, that would tell me that something might be getting a little better. Until then, it's still a heavy resistance. It's a supply area and it's going lower. So the chart of the day, the mystery chart, is Netflix. We're going to wrap up our show right now, folks, and go to the 3 and 3. So at the end of every chart, at the end of every show, 3 charts in 3 minutes. And here we go. I'm going to go quickly through here. Sorry. Ba-bump. Chart number 1 is the ratio of consumer discretionary to consumer staples. When I'm thinking about this relationship, it's all about offense versus defense within the consumer space. And as if we need another indication that things have been difficult, I don't mean to say this is a new idea to you, but I think it does illustrate the overall transition to consumer staples from consumer discretionary. This is not a new phenomenon. This has actually been happening really from the beginning of the year, right? Year to date, this had been a flat ratio showing the evenness between the two. And since then, it's really accelerated to the downside. The market sell-off really exaggerated that. The top half, we're looking at the cap-weighted traditional ETFs, which includes an overweight for Amazon. If you look at the consumer discretionary sector, this is the equal weighted ratio. And you can see that it's been much overall more negative. So I think it's really illustrating the relative weakness of consumer discretionary versus consumer staples. Shows you institutions are remaining on the defensive side of that ledger. The second one is the market trend chart. We've looked at this before a couple of times. We look at it as part of our normal weekly routine on Fridays. I did want to note last week it finally gave the negative signal illustrating the long-term trend rotating more bearishly. And again, I know the market's been selling off. That's the point of the tactical part at the very bottom, which is more the short-term read, which has been negative since mid-February. This is now agreeing with that from a long-term perspective. So my long-term trend following model that I followed for years is now 100% in the negative. So we're going to track that to see if and when we get some sort of positive reversal there. And then the last one of the 3 and 3 is looking at the percents of advancers and decliners. We talked about this earlier in the market recap, talking about just an overall breadth update. And I think today we had another 90% down day. And again, if you start to see a group of those, that really shows you the negativity that you see with so many stocks moving down versus moving up. But it's also worth noting that 8% of stocks were up today, actually. So my question is always, well, hold on a second, what were the stocks that did not do this and actually closed higher? And so the real point of this chart, I think, is a reminder of the value of screening. And remember, in any market phase, there are stocks moving up and moving down. And ladies and gentlemen, that's our show for today. I want to thank you for joining us every weekday for the final bar. Thanks again to my guest, Ari Wald from Oppenheimer, for sharing his insights with us. We've got some great content on our YouTube channel, so check it out if you haven't already. Also, please send your questions to us anytime. The final bar at StockCharts.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.